Student loans, how they affect you when you're qualifying for a mortgage. Did you know that about 20% of US citizens have student loans? When we're qualifying you for a mortgage, we take a look at a few things. And one of those primary things are your liabilities. One thing we come across often is that people have their loans in deferments, not actually making payments. So when we pull a credit report, it shows that their monthly payment is technically $0 a month, which may be true for the time being. But the way that different loan programs require us to calculate that will kind of vary. So I'm gonna kind of dive into the way that these are calculated on different types of loan programs. So to kind of start off, we're gonna talk about conventional financing. So there's two primary conventional financing type loan programs. That's gonna be one through Fannie Mae, and the other one is through Freddie Mac. So how the way Fannie Mae makes us calculate student loans is that on Fannie Mae, we have to take 1% of the outstanding balance. So for example, if you have $100,000 in student loans, that's going to be hit as a $1,000 monthly liability. You may not be technically paying $1,000 a month, but you are going to be hit with that as a liability per Fannie Mae guidelines. Now, the other conventional financing option is through Freddie Mac. And Freddie Mac is a little bit more lenient when it comes to student loans, and they only make you require and be hit for 0.5% of the outstanding balance. So same example, you have $100,000 of student debts, you'll be hit with a $500 a month liability. Again, not something you're actually paying on, but for the sake of just taking into account those student loans, we have to use that as a liability. So now the next few loan programs we're talking about are all government loans, and they all kind of vary slightly on how they're calculated. The biggest information that I got right here is with FHA. So FHA is probably, out of the government loans, probably the most common type of loan program we use. And up until about a week ago, FHA was requiring that you would use 1%. So that had a huge impact on borrowers, as that was just a big 1% smack of having to use these monthly liabilities. Well, recently they just switched that to a 0.5%. So again, think about an example, at 1%, $100,000 of the student debts equated to $1,000 monthly liability. Now we take that as a 0.5%, which drops that down to about $500 a month, which is huge in the spectrum of qualifying for a mortgage. On VA, it's a little bit different. So what we do on a VA loan is we take 5% of the outstanding balance and divide that by 12. And that's how you calculate the monthly liability for a student loan. Now finally is USDA, and USDA basically falls in kind of similar lines of FHA, but they have a little extra clause in there. So they either take 0.5% or they take what's on the credit report, whichever is higher. So they're gonna hit you on one or the other. Really just depends on which one has a higher price. So that's kind of how student loans are equated when it comes to qualifying for a mortgage. If you have any questions, feel free to reach out. Happy to help. Talk to you soon. Bye-bye.